Hey everyone, as always, I'm Hunter Satterfield, one of the partners here at CWA, also one of the members of our investment committee. I am joined by Brad Sanders from Tectonic Advisors, and then my fellow partner, Brian Bortz, a partner here at CWA and the head of our investment committee. And this is your March monthly update. For the month of March, S&P 500 stocks were up right around 4.5%. Global stocks were up 2.6%. Domestic bonds were down 1.3%, and global bonds were down 1.9%. So we can see obviously some differences in what is happening or what has happened over the past month in March between stocks and bonds, and we're going to talk about those things for sure. And I think the best place to start, Brad, is to come over to you. I think one of the things that Brian and I, as advisors here that work directly with clients, and then the other advisors that we're talking to are getting a lot of questions about. Probably the two biggest topics are inflation fears and concerns. Hey, we've sort of got this looming inflation. I'm hearing a lot about it. What does that mean for my stock portfolio, my bond portfolio? And then secondarily, interest rates. At some point, interest rates are going to rise. What does that look like? What's the effect? So maybe you could spend a little bit of time talking about those two things and what you guys are seeing there at Tectonic.
That's one of the biggest issues that we're watching too. And we're in a very interesting time right now. We have inflation expectations at a decade high. We've had tremendous amount of money printing over the last 12 to 18 months to combat the pandemic. 40% of all money that's ever been printed in the United States was printed in 2020, and that's not including what just happened. So, that's obviously going to spur, we all learned in school that more money chasing the same amount of goods causes prices to rise, and so that's what I think is kind of stoking those fears. And then at the same time, we've seen interest rates start to move higher. The 10-year Treasury is around 1.7% today, and so that's kind of pushing everybody towards that direction. Like, oh no, we're going to have rising rates and rising inflation. But on the flip side, there's a lot of signs that that's not necessarily where we're headed in the short to intermediate term. There's a lot of confusion around what's actual inflation and what's left over from the pandemic. A lot of people point to commodities. They'll say, oh, lumber's up, however much it's up, a tremendous amount this year. Oil's up X, and they're all big double-digit percentage numbers. And they say that's a sign that there's inflation. Well, yes and no. I mean, the definition of inflation is just prices going up. But what's going into those inflationary numbers? Well, think about last year. The whole world was shut down, and we're just now starting to open back up, and we've just now started to get this vaccine to wide rollout. So if you wanted to build a house last year and you're about to break ground, lumber prices are through the roof because guess what? While we were all at home, so were the lumber mills. And so they're all fighting over the same amount of goods, and that's pushing prices up because it's called an output gap. And you have to really fill that output gap in order to really get the supply and demand balance back into place and then be able to see where the inflation's coming. So I think a lot of what's going on in the market is a little bit of a temper tantrum for bonds, followed on by inflation expectations being high, even though headline inflation is not really following suit yet. If you look at things like gold's performing poorly this year. It's down double digits. If we were having real tangible inflation in the economy, gold would be up. And there's a lot of other signs that, this inflation expectations, that may be a little bit early here. We certainly might get that inflation later, but I think it's a late 2022, early 2023 story at the earliest. We're just not there yet. We might run hot this summer or something, but I just think that all that's going to take us, this was a big deal, 2020 shutting down the economy. It's going to take us, 18 to 24 months to get kind of that supply and demand equation back in place. And the other part that's always missing from these inflation arguments is the amount of debt that's out there. The national debt's over $28 trillion today. Trillion, capital T. That's a lot. That's 130+% of GDP. There's a reflexive point when you have that much debt and you have more debt than your actual revenue, where debt payments, if interest rates go up, start to work against growth. They start to change spending patterns. And that works for human beings as well as economies. And the last couple of times we've seen interest rates rise and people's kind of hackles get up and they start getting worried about it, you get to 2 to 2.5% on the 10-year Treasury and things stall out. There's no reason to think that that's not going to happen this time too. So we're in very much a wait and see mode here. Yes, we're no longer bearish on inflation at Tectonic like we have been for the last decade. We're constructive on the idea that could happen. It's just not really a 2021 story in our opinion right now.
Yeah, that's helpful. Thank you. I mean, certainly something that we've gotten from a lot of clients. And I think the other thing that we're seeing, Brian, to come to you, is we're seeing those numbers that we flashed on the screen there at the beginning. We're seeing that was just 1 month, and we're seeing stock indices that were up quite a bit over the last month and bond indices that were down quite a bit from a bond perspective. So, can you talk a little bit about just the volatility that we're seeing, both micro and macro levels, with the different indices? It's not just one indice, it's also happening in others. And then also the individual indice, the names themselves have got volatility. Can you talk a little bit about that and what we're seeing?
Yeah, sure. Thanks, Hunter. As Brad just mentioned, the economic stimulus that we have had has also created a lot of economic optimism, so growth, expansion. But on the same token, it's also created fear over how it's going to get paid, and at some point in the future, is there going to be higher taxes, inflation? How does that all work out? And so investors right now, our clients right now, are really kind of stuck in the middle of that. They want to be optimistic because there's all this free cash flow, but they're worried. And this is the first time, literally in decades, that we've had a fiscal policy and a monetary policy continue to ease and expansion accelerate. And it's one of those situations where we're really trying to hold our clients' hands to say, hey, we know that you have a lot of pent up demand of wanting to do things. You spent a whole year of not doing anything. We know that you have a lot of liquidity and savings. We know that the interest rates are low right now for a banking system that's kind of out there ready to lend you money. But let's make smart decisions, because I think the decisions we make now are really going to impact a lot of our clients' financial plans. And when you look at an investment perspective and the indices that are out there, a lot of the indices are not cheap right now, and that gives our investors and our clients reason for concern. I use the S&P because it's the one that everybody's familiar with. The S&P 500 right now has a PE ratio that is about 22 times earnings, which is not nearly as bad as it has been recently, but historically speaking, the 25-year average is about 16 and a half. So we're still quite a bit more expensive than average for the stocks in the S&P 500. And then, conversely, the dividend yield is only about 1.5% when it's been slightly over 2. So investors are just concerned. And I think that that's really what the advisor's role is right now. At least what we're trying to do with our clients is say, look, there are opportunities here to take advantage of this market. And now's a really good time, but we just have to be smart about it.
Yeah, that's great. Thank you, gentlemen, both for those thoughts. And I think you're right, Brian, as we finish off, just, we're telling our people just to know what you own and stay the course, and things are optimistic. But at the same time, the key is just to stay diversified and keep to the plan, to keep focused on that plan. And that driving that forward is going to bring you the success from your investment perspective. So thank you both for joining me. And we will be back in front of you guys in the next month with our April monthly update. Thank you so much.